Well, hello and welcome to the National Fintech Organization and this next installment in the series NFO's Growth Garage, Get Smart and Get Connected. Today, we'll hear from Terry Ammons of Wipfli, Helen Herring from First Century Bank, and James Stevens of Troutman Pepper as they discuss critical steps to prepare fintechs for working with financial institutions. All attendees are in listen-only mode, but the chat feature is available at the bottom of the window for comments and questions. Please give it a try now and let everyone know what part of the world you're connecting from. And as we go along, add your questions for our panelists. The session is being recorded and will be available on demand within the next few days on the NFO's YouTube channel. And now, I'd like to hand it over to Terry Ammons to get us started. Terry?
Hey, everybody, and welcome. Thanks for joining us this afternoon or this morning, depending on where you're at. I'd like to first welcome everybody. If you're not familiar or haven't ever been to one of these growth garages before, welcome. My name is Terry Ammons. I'm a partner with Wipfli, based here in Atlanta, and I oversee the fintech practice for the firm. And also, Wipfli is a founding sponsor of NFO. At the end of the presentation, there'll be some information on how you can learn more about NFO if you don't know already. So be on the lookout for that. As we talked about earlier, we're going to be talking about how fintechs can get prepared to work with FIs. And I want to talk a little bit about the reason why we're doing this. Is, you know, we sort of live this every day, myself and the team that I lead, and there's a lot of stuff in the news. There's been a lot of changes over the last few years about how banks and fintechs partner up, the sort of structure that those things fall under. And here recently, you may have heard some of the regulatory issues that have come up with some of the banking as a service bank platforms, both the platforms themselves, the bank and the bank. So we're going to talk about that. And joining me today, I've got James Stevens and Helen Herring, who are going to be, James is an attorney with Troutman Pepper. Helen Herring runs the FinTech partnership group for First Century Bank. So I'll go ahead and let them introduce themselves. James, why don't you go first, and then Helen.
Thank you, Terry. Happy to be here. So my name is James Stevens. I'm a partner at Troutman Pepper, which is a nationwide law firm that has, among other things, a industry group that focuses on the financial services industry. We have about 200 lawyers that are dealing with financial services providers on a daily basis. I'm a co-leader of that industry group, and in my personal practice, I do a lot of corporate work, bank partnership work, regulatory work for fintech companies, as well as the banks that are providing services to them. So happy to be here. Thank you.
Great. Thanks, Terry. Thanks, James. It's great to be with everybody today. I'm Helen Herring. I'm Senior Vice President of FinTech and Strategic Partnerships with First Century. I've been with First Century about 5 years. We started in the FinTech space in the early 2010s, I think, before anyone called it, you know, the word FinTech or even banking as a service was around. We're interesting. We have a community bank footprint, especially when you look at our size, we're about 500 million in assets, but we're very focused on innovative payments and innovative technology. And so we work with a number of FinTech partners, and look forward to the panel today. Thank you.
Well, great, thanks. And you know, for full disclosure, Helen, First Century Bank, they're a client. They're also a client of Troutman Pepper, and James and I work together on other mutual clients, and you know, we're on the phone with each other quite a bit. So there's a lot going on in the space, and you know, the conversation we're going to have, we think we probably had it a couple times on a number of these topics. So we thought it'd be good to share, because there's been a lot of stuff, a lot of things going on. You know, one of the things that just to sort of level set here, what's happening in the industry, and this is not a brand new thing, but it's something that's built up over time. You know, there are more and more ways that fintech can partner with banks. There are more and more banks that are trying to put together a banking as a service model. There are also the legacy core systems, and companies are a lot more willing to expose their data to smaller companies. So there's more and more opportunities for fintechs to partner up with banks. And by the way, there's a fairly robust vendor management program that banks use to look at their fintech partners. We're going to kind of take the other side, sort of vendor management from the vendor perspective, and the vendors here are the fintech. So I guess just to start us off, James, kind of to level set, can you kind of talk a little bit about the regulatory nature in which the fintechs operate? I mean, just real quick, many fintechs are only sort of get touched from a compliance standpoint by their bank partners. The very largest technology providers, they'll have the examiners that come to their offices and do work, but generally it's indirect. Can you talk about the way that works?
Yeah, so I mean, it is possible for fintech companies to be directly regulated if they have chosen to go down a path of getting state licenses, for example, to be a lender or a money transmitter, check casher, a variety of financial services that banks have the innate ability to provide. Non-banks can get those same powers by getting licenses, and in that case, they can be directly regulated. Of course, they're also directly regulated if it's a consumer financial services product by the CFPB, which is kind of the 800-pound gorilla. And so that is something else they have. But the biggest kind of more immediate, assuming you're not licensed, the biggest immediate kind of regulation that a fintech is going to have, to the extent it's partnering with a bank, is really the indirect regulation by the bank regulators. The bank regulators of every bank has a federal banking regulator. If it's a national bank, it's the OCC. If it's a state bank, it's the FDIC or the Federal Reserve. And those agencies get together and they come out with guidance independent to them, and they do independent guidance. And they have come out with very specific guidance on these bank fintech partnerships, where they say that these are third-party relationships between the bank and their fintech partner, and as a result, the bank has to do, a risk assessment with respect to what risks they're taking on through that partnership. They have to do due diligence on that third party to, understand, what they know, what is going on with that company, and what are the issues that they need to be aware of. They need to have, full really robust contracts in place, so that the parties understand their relationship with each other, and very important, that the banks have to have ongoing oversight. I was on a panel last week where an OCC examiner was on there, and he said, one of the first things we look at when we look at banks is whether they have updated their risk management framework to reflect the fact that some of the things that they were doing directly are now being done indirectly through a fintech partner. So when the bank has that sort of regulatory framework in place, what it seeks to do through its contract and through the relationship is to basically, put itself in a position where it can comply with those regulations by sort of indirectly pushing those regulations down to the fintech partner. So if they are supposed to provide a certain type of disclosure or obtain a certain amount of information, from a customer, and that customer is coming to the bank indirectly through the fintech partner, then they're going to push that obligation down to that fintech partner. They're going to do due diligence to make sure that the fintech partner can do it, and they're going to oversee it on an ongoing basis to make sure it's going on. And if they don't do that, then they run the risk of running into this regulatory buzzsaw with their own banking regulators for failing to properly oversee the fintech partners. And one final point is the CFPB is also very familiar with these arrangements, and they have made the same kind of statements directly to the fintechs that says, not only are these banks responsible for all this, risk management, but you as a fintech partner, we're looking at you also. So it's a mix of direct and indirect. But the most immediate and probably the biggest pressure point for the fintech companies that we're working with in these banking as a service partnerships is that indirect regulation through the bank partner.
Yeah, one thing just to kind of to level set here, you know, we're kind of talking about, the way I think about it, at least two different kinds of partners, technology partnerships that FIs have. By the way, I'll probably say banks. I mean banks and credit unions, but FIs I'll try to say. But you have the direct relationship with some of the core providers, some of the traditional providers, where we're using technology to provide those services to the bank customers, right? That's a fairly well-established process that people do now. It's probably getting more complicated because, again, some of the cores are allowing other products to sort of, you know, get integrated in their tech stack. So that's a thing. And then what you had mentioned sort of at the end, and I'd like Helen maybe to talk about this because they have both, is where we're providing the back office, you know, basically plumbing for the fintech, where we don't have a direct relationship with a customer, and where we're providing loan or deposit or a payment product. And then so you've got some extra scrutiny, as opposed to just making sure everybody's got their stock reports and their financial statements. Then there's some additional requirements you have. Helen, can you talk about that a little bit?
Yeah, absolutely. And so it's funny when you mentioned things like a SOC report and PCI, right? A lot of if we're talking to a new fintech partner or a prospective partner, right? They always want to see FCB's due diligence list, right? And we have a list of basics you want to see, right? We do want to see SOCs. We want to understand how OFAC screening is done, for instance. We want to understand how the fintech's clients are identified, right? We want to understand your CIP program and your KYC program and how all of that flows. So you have some standards. But I think one of the most important things to point out is you really don't want to work with a bank that just has this one size fits all checklist and you complete the checklist and you're done, right? Because I think that's where a lot of fintechs and banks alike really get in trouble, because there are so many, you know, we have several, I'm sure many attendees on the call that have these really innovative, nuanced products out there, and you need a set of diligence that really matches up with that. And so it's the onus is really on the bank. Like Terry said, even if you're outsourcing that back to the fintech to oversee some of those due diligence processes, it's on the bank to make sure we're, you know, doing sampling, that we're making sure the process is working as it's supposed to, that the program, for instance, if you get it onboarded and you get it live, that it doesn't change 6 months down the road or a year down the road. And, you know, some of the product changes may affect some of the diligence items as well.
Yeah, and no, that's good. One of the things of sort of a data point here is I mentioned at the top that there are more and more banks that want to provide banking as a service to their customers. But I've read a couple of, you know, consultants who are kind of looking into the future, and they say that the market right now, they think can you know, kind of absorb maybe 300 of these banks, and perhaps maybe it's even lower than that, right? But I think one of the things that's happening is there are a lot of people who are trying to get into this, and I know, Helen, I'm familiar with the bank. You guys did a lot of legwork many years ago to put that technology layer in place, right? And so you guys have sort of done it the hard way. I know there are several others who have been doing this for a while, and they've like I said, done it sort of the hard way, built it themselves. Now there are some sort of companies that are sort of sitting in the middle between the fintech, and we're working with some right now actually, between the fintech and the bank. And part of their value is they provide other services that the fintech may need to be compliant with the bank. And it gets sort of, you mentioned about due diligence and the checklist and stuff that you need to apply to, depending on the service and the product, et cetera. But one of the things that I'm starting to see in working with some of these fintechs, some of these intermediaries, I'll just call them. Sometimes they're API providers. They have a direct connection to a bank. They may have a KYC product that can be used, or maybe loan products, deposit products. And so I guess, James, thinking about that, how do you think the regulators are viewing that? What to me, what that does is that puts at least one extra layer in the compliance, because what I've seen is these middleware, these intermediaries are the ones that are trying to get the fintechs who are on board. They're the ones doing the due diligence and the compliance stuff. How do you think the examiners or the regulators, or maybe generally, how are they looking at that?
Yeah. Well, I think that, again, the big overarching theme that you see from the banking regulators is risk management, right? And so they worry about and this third-party vendor management stuff. They've been putting stuff out. I've been doing this for almost 2 years, I guess. They've been putting stuff out for that whole amount of time. Banks are like the ultimate outsourcers, right? And so there's been third-party vendor management guidelines out there forever, saying basically, if you're giving a third party the ability to do stuff on your behalf, what's the framework look like? What's newer to me is I've recently learned the word, what's it called? A fourth party vendor. I think that when you start talking about middleware, you start talking about fifth and sixth party vendors, right? You're talking about your vendor. And I think that the more indirect and the more levels that get between the bank, that's the regulated entity, and the person that's actually touching the consumer, that's where the real risk is I think that there are opportunities for more failures, right? It's like the nuclear power plant with all those switches, and you're like, God, if that one switch is switched, that's problematic. It'd be a lot better to just have one switch that you got to keep an eye on. But that being said, there are tremendously effective providers out there that can bring, it could be that the reality is that middleware provider is so much better positioned to comply and to help that fintech company comply than the fintech company is, because it just got created. It's a couple of people with an idea with some seed money. So I think there's definitely a place for those companies. I think there's a growing place for those companies. But again, you get more opportunities for something to get sort of screwed up in the sense that you've got more links in the chain.
I was going to do exactly what James just said, like this, right?
This thing, I think I hope that's not like a politician would do. I don't mean to do that.
No, I mean, it's exactly right. And as neobanks are looking to get in this space, to James's point, outsourcing is certainly a normal part of what we do, right? Like, it may not make sense if you're trying to build an API platform, it may not make sense just from a time or a resource perspective for you to do that yourselves with an internal team. I don't know if anyone's tried to hire developers or programmers lately, but it's hard and expensive. So there are some great partners out there, right? Like, whether you talk about a tech stack or middleware, or these companies that kind of sit on top of your core. There's great things to outsource, especially technology. If it's API integrations, if it's payment integrations, those things are great. You have to be really careful with what compliance you outsource. You really want to make sure. I think doing a lot of things the old-fashioned way when it comes to compliance and BSA and risk review has worked really well, not just for First Century, but other banks that have been in this space for a while. The banks that tend to be successful and not have as many problems down the road tend to have a really good foundation and compliance and kind of understanding what to look for on these various fintech programs.
Yeah, I know that some of the companies that we're working with right now, I'm surprised. I shouldn't be, because I've been doing this a long time, and I've seen these companies come into existence without really understanding sort of the regulatory nature of what they're getting into when they want to work for a bank. They go down the money service business path and figure out, oh, it's better to work with a bank. I'd rather work with a bank because it's a lot less hassle. But you're trading one thing, one thing for another here. But but you mentioned BSA, and I want to kind of talk about, we're not going to name names here, right? But one of the things that, and the thing that prompted this for me, and I know James and I have had this discussion a couple of times, but there have been some banks, and it's the banking as a service banks who have kind of been in the news lately. There have been some regulatory scrutiny on those folks, to say the least. Some of which has been formalized in examination reports that have been made public. Some are just sort of in the ether that are out there. And from talking to people in the industry, nobody will tell you, it's sort of like all hearsay, but what we understand is there are more banking as a service banks who are going to get scrutinized, and they're going to really be looked at in a different way. And so, but for the cases that I know about that are real, and maybe I'd like to get James to talk about this, what I see at the core, the way these people usually, and the reason I'll get to the point in a minute, but what happens is the way the banks who are doing the banking as a service, managing these things, I think the first thing that happens that's usually bad, that's pretty clear to the examiners or somebody from the outside looking in, is they've sort of dropped the ball on Bank Secrecy Act stuff. And why that is, I don't know, but that seems to be it's been a hot button issue for a while at the banks, and it still is, right? So it's the initial know your customer information that's required, and also ongoing monitoring. So people have, there are tools that you can use, but you got to have somebody who knows what they're doing. You've got to monitor the transactions. There's some reporting issues. And ultimately, it goes back to the bank, and you've got to coordinate with the bank partner. And if you have somebody in the middle, maybe it's not as clear on how to do all that. And sometimes I think that the banks maybe don't understand exactly what the fintechs are doing or some of the services. So James, I know again, that was a big mouthful, but any thoughts on that, on the BSA stuff? Because to me, it seems like it always starts with the BSA.
Yeah, I mean, you're right. There is a lot. I mean, BSA is hard for banks offering their services directly to comply with, right? It's been, as soon as I started practicing law was 9/11, and the BSA was everything, right? Because everybody was worried about terrorist financing. Like that's what it was sort of, that's what everybody was focused on. And it's just continued, and it's continuing on as we move to this, people are not coming in. You're not putting your eyes on people that you're doing business with. Everything's being done remote. There's an ability to commit fraud and to do all, and you've got to check this stuff. And so the Bank Secrecy Act has been and will continue to be a massive regulatory headache. And I think that what I would say to fintech companies as they're partnering with the banks is banks are actually good at this stuff, right? They're not just renting their charter. They're also, if they're doing anything, they're selling you expertise. They're selling capabilities. And so when you're looking at a bank partner, you want a bank partner that's good at those things. Somebody, I'll never forget, a Coastal Bank, the CEO was speaking at a conference last year. I loved what he said. He said, we didn't know, we weren't making any money. And so we figured out how to weaponize our back office, right? That's what you need, is you need a bank with a really good back office, not the one that will give you the laxest oversight. And, banks, regulators don't like tell banks what to do. If that's what your venture capital lawyer tells you that happens, they're wrong. That's not what happens. What banks are allowed to do is go out and do things, and then they just get hammered when they screw up in hindsight. And then what the rest of the industry does is observes what happens to those banks, and then tries to fix it before they get hammered. And so, when you have a period of this explosion, I'm not surprised that all the hindsight, all the criticism of banks that allowed fintech companies to go wild and not comply with BSA, or crypto companies to, not have controls over their money, that's not going to happen in the good times. That happens when the problems start, and it's all historical, sort of, from the sidelines, you did all this stuff wrong. And so you got to find a bank partner that has the back office, that knows what they're doing, that takes it seriously, that's kind of a pain in your behind. I'm supposed to, they told me not to cuss. So you got to have one of those banks. And BSA is a great way to evaluate whether your bank has the capacity to itself stay out of trouble, which I promise you will help you stay out of trouble.
Yeah, and I guess Helen, you guys as a bank, obviously you've got your own customers and you've got BSA, and then you've got the partners that you deal with that probably have some BSA requirements. Can you just talk a little bit about that, how you guys handle that?
Yeah, absolutely. I think I'll point out too, we talk about like the bank does have direct customers, and then maybe you have customers through a fintech. Those fintech customers, even if the fintech is the one that's the face of the product, and they're the ones that are acquiring the customers, they're doing the marketing, it's their TV ad that you're seeing. That is ultimately still the bank's customer, right? Like if you look at a card program, for instance, the bank's listed as the issuer on the back. If that fintech files bankruptcy or becomes insolvent, the bank has to pick all of that up, the servicing, the wind down of the program. I mean, that's, obviously one of the reasons that the diligence process is so important for banks. And along the same lines, when you talk about BSA requirements and CIP, a lot of those, depending on the use case for the fintech program, there may be beneficial ownership that comes into play. A lot of these kind of standard BSA, CIP practices that you have with your, traditional core retail bank customers often applies to fintech customers as well. And to James's point earlier, we have this kind of fourth party due diligence. If you're working with, a client that's a business and has all of their clients underneath, I mean, it kind of falls under that umbrella.
Yeah, I mean, one of the things that when James talked about fourth parties, I mean, the fourth parties have always kind of been part of the outsourcing issue. Helen, just one more follow up. Like when you're dealing with obviously some of your fintech partners where you guys don't technically own the customers, so do you guys take responsibility for the BSA, or do you put that on them? I guess it depends on the circumstance. Can you talk about that a little bit?
Yeah, it depends on the circumstance. A lot of times we do diligence behind the fintech, right? Like again, I mentioned OFAC screening before.
Yeah.
If you have, your fintech partner or your processing partner that's involved, if it's a card program, if they're actually doing an OFAC pull on, say, every new account that comes in, the bank in place needs to have some type of oversight on that. And it needs to be consistent, and ideally it's automated, right? You don't want just a person randomly pulling a couple of things and say, oh yeah, that looks good, right? You want a clear, consistent process. Now, sampling's okay. If in some of these larger fintech programs, I mean, we have fintechs that are opening 5, 6, 7,000 accounts a month. No regulator is going to expect the bank to go behind and look at the diligence or the KYC package on every single one of those clients. But, is it a sampling of those, and you have that consistent sampling model applied throughout? That makes sense. And those are the type of things that regulators want to see.
And James, speaking of that, so we talked about I've seen some of our clients that basically it's ultimately the bank's responsibility. They build into the contract that the fintech is sort of acting as an agent on their behalf to gather all this information. Ultimately, the bank is responsible. There's reporting back and forth. How do you normally see that? I mean, I know you look at contracts and stuff. How would if you were with advising a fintech, I mean, how would you advise them around the contractual obligations around that kind of stuff?
Around BSA specifically?
Yeah, around BSA, general compliance.
Yeah, I would say, the one of the things that the regulators have come out with, the interagency guidance actually spells out specifically, 25 things that they expect to see in bank vendor contracts. So if you're entering into a contract with a bank and you're scratching your head and saying, why is there this section that says that I have to have, this kind of insurance or whatever. It's because it's actually spelled out in guidance that it has to be in there. But one of the things that they spell out is scope and responsibility, who's doing what. So I think that Helen's right. It's not every program is not the same. Sometimes depending on the nature of the product, the fintech may be gathering the information. They may be then shipping the information off to their vendor who's running checks and reporting back, who's monitoring for fraud. And then the bank just may be monitoring that process, both through its automated systems and through sampling or whatever else is going on. Or it may be that, we certainly have seen fintech programs where the customer is, the fintech is much more of just an origination. They're designing a product, they're bringing the customers in, and then and then that customer gets onto the web page through APIs. They're actually interacting directly with the bank. So there's really no right answer on that. But I think that what you want to see from a contractual standpoint is absolute clarity on who is doing what. And then, what you should expect to see as a fintech is that if there are changes to that, any changes to that, and I would say any changes, there's probably not a materiality qualifier when it comes to this kind of stuff because the stakes are so high, is that if there's any changes, if you're adding a new vendor, if you're changing, that you're doing this or doing that, all that's going to have to require the bank's approval because it's the bank's laws that apply to it that we're trying to ensure compliance with. And so it's 100% their responsibility to say yes or no. Same thing with marketing, anything that has a compliance, anything that has just a real strict obligation to comply with, with consumer protection laws, or any kind of, BSA is actually a sort of a safety and soundness law. Anything like that is going to require probably bank's approval with no materiality qualifier. You can change your logo, that's not going to require approval. But
No, I mean, that's good. That's really, and you're sort of driving the point home of that's why fintechs need to understand this and be ready for this, right? That was sort of a bullet point that I wanted to make. And Helen, real quick, just shifting gears just a little bit. We've been talking about due diligence, initial and ongoing due diligence. Can you kind of give like an overview? You're a banker working with the fintechs. Can you kind of give an idea, just a general? I know every program is different and it depends on what they're doing, but can you kind of give an overview generally about what a fintech should expect from a bank, that they need to make sure they have in place?
Yeah, absolutely. A lot of the, James mentioned earlier, a lot of the larger fintechs may have their own licenses. They may be a money transmitter. On some of those kind of more robust fintechs or more robust programs, we oversee the licensing to make sure they're licensed properly. A lot of times those fintechs will have their own risk review or their own independent audit. Understanding and getting updated copies of those on an annual basis is really important. Making sure that the products that you as a bank support are clearly outlined in those risk reviews. And again, understanding when things change, making sure that those changes are incorporated into those auditing documents as well. I can't stress enough the importance of a SOC. I think Terry knows that more than anybody. Again, especially on the larger fintechs. And some of the startups we work with, you may not have a SOC day one. I mean, we're pretty understanding that it's a developing program. There are things you're working out. But generally once the program is live and underway, a SOC, and if it's a card program, PCI, those are always things that we're going to require. We want to understand fraud mitigation procedures. And a lot of times, if you have a lot of fraud on a program, for instance, that it's usually not just friendly fraud or just a coincidence. Sometimes there's really breakdowns in, whether it's onboarding or whether it's the fintech's compliance program. We had a credit card program a few years ago that was starting to really see some spikes in fraud in certain areas. And we at the bank, we connected the dots and saw the fraud that was happening. And we looked at some of the onboarding packages, the fintech had a hole in kind of their algorithms when they were onboarding, and it was actually directly causing some of this fraud, right? And you see that happen a lot. So, having just a high level understanding of how the program's supposed to work and all of those compliance pieces being applied properly is always important.
Yeah, let me drill down on that a bit. So, and I'm not just talking about not just the compliance, but maybe general due diligence. And I think you guys have probably worked with some companies that were maybe younger companies. How would you address, like, I know one of the due diligence requirements for every technology vendor usually is financial statements, right?
Oh yeah.
So we have financial statements of companies, and we serve these clients as well who have not made money. They never made money, right? And so, but they've got capital, but they don't have profits yet. How do you guys look at? I'm just wondering. I've always kind of wondered that. How does the bank look at that? Maybe James, I don't know if you know how the regulators would view that. Can you give me any thoughts on that?
I'll maybe start and then James can jump in. So going back to what James was talking about, having a very clear, well-written contract is important. You want to have, banks are willing to work with startups, but you want to have pieces in your contract that allow you to get out if it doesn't go well, right? You want to have reserves in place. You want to have proper termination language in there. If X, Y, and Z doesn't happen, that, it doesn't work, you maybe want to have an out, right? So those are really important. At the end of the day, banks, if you have the capital and an experienced management team, including compliance, and a fintech partner that really understands the importance of those, if you have that combined with a good product, and when I say good product, I mean it's innovative. You're able to acquire customers in a way that's doesn't kill your financials. You're not spending $80 million a year trying to buy Super Bowl ads all the time. That works for some more established fintechs, but probably not if you're starting out, right? Having more different channels of acquiring customers is important. Those are the things you look at. And certainly having the technology, I think, is first and foremost. It has to be a product that's appealing to whether it's consumers or other commercial clients. It has to be a product that we think has legs.
Yeah, I guess it also makes a difference if you're selling to the bank's customers, or if they're a brand and they're having to gain their own customers. I mean, based on how much it costs, acquire.
And most of the fintechs we work with, they have their own customers. So the customer acquisition piece is really built into their technology and their product.
I'll just say that, I mean, I think that from a regulatory standpoint, of course, there's guidance on this diligence, and I'll mention financial, but let me go off a little bit further than that too. On the financial piece, they're looking at the ability of the fintech company to remain in business and fulfill its obligations, right? And so that's why I mentioned that about insurance, right? That's one of the ways that you can ensure that you can fulfill your obligations. If something really, really bad happens, is there a third party that you paid a premium to be there to backstop you? That's why banks ask for reserve accounts, right? So if I've got a chargeback risk because you're sending, your product is sending ACHs that might get reversed because of, fraud or something like that, and you don't have the ability to stand behind it. One way that I solve that is by saying, hey, put $100,000 in a reserve account, and that approximates this amount of activity, and I feel good about that. And it's also that ability to stay in business. I mean, like Helen said earlier, I mean, and we're seeing this more now than really ever before, is fintech companies are failing and banks are having to step in. And so that's not, nobody wants to see that from a regulatory standpoint. And so they would prefer that, if something is not working, that there can be an orderly wind down. So I think that's really on the financial piece. The only other thing I'll say about due diligence is that another thing that I would tell our fintech clients that we're working with as they're preparing, I call it kind of getting ready for the due diligence process, is they're going to definitely underwrite. Banks are always going to underwrite the people and the qualifications, and they're going to look at the business. Is it chartered with the state? Is it in compliance? If they filed their $100 to, every March you have to pay $100 to remain. And I mean, you start talking about startup companies, and a lot of that stuff is not present. And those kinds of lapses may work for a seed investor, but they're not going to work for a bank partner. And so you really want to be buttoned up in terms of, having good, well-written, documents, corporate governance, minutes and articles and bylaws and operating agreements, and having a bio. If you've got somebody that's on your board that's been in jail for fraud, you might want to get them off the board before you go talk to a bank. Stuff like that. That's a made up example. Thank God. But those are the kinds of things, because it's not just like this operational financial. There's always this kind of reputational risk that banks are going to worry about, and so that they're going to underwrite that by looking at the people.
Yeah, I think we all know, or we've all heard, the days of sort of easy capital raising it's kind of gone away for fintechs, although the smaller ones are still able to raise capital, maybe not at the same valuation. We still have some smaller fintechs, and probably some people who are listening to this who are still are in a good capital position. I would think if I'm going to go to the banking market, or if I want to get a bank partner and I want to partner up, I want to have a game plan about how I'm going to get to profitability, or how I'm going to, how not necessarily how I'm going to get to the next round, the B round. We know we have clients, and they've been successful, but I mean, they've raised what I would consider a significant amount of capital with no audited financial statements, right? I mean, there are people who are out there who are willing to write $10 and $20 million checks, and so I think it's a different ballgame now. So okay, we're about 45 minutes in. I want to do one last item here to talk about, and then we'll start wrapping up. But I mentioned earlier that we've seen, James and I and Helen, I know we've had these conversations about specific BaaS banks who've gotten some trouble, poorly managed programs, and some of it I mentioned BSA, some of it was risk management, and so a lot of these people had partners. I mean, had fintech partners, some of which were doing the right thing, trying to, of course, right? You got a couple bad apples that can kind of spoil the whole bunch. But I guess number one, James, if get both of you guys maybe to speak on that, and to really my sort of thesis here is that I think the fintechs, as they make their bank partnership decisions, they need to be thinking some of those things that you guys already talked about. They need to make sure that almost you don't want to have the easiest teacher, in first grade. You want to have somebody that's going to challenge you, that's going to make sure you're doing the right thing. Because if they're not doing that to everybody else who's on their partnership list, if they go down, they could potentially jeopardize the banking as a service, whole business model for that bank. So any thoughts on that?
Yeah, Terry, I think that's a great thing. I think that Terry and I have had this comment we keep passing back and forth. A bank is only as good as its worst fintech partner, and I would say a fintech is only as good as its bank's worst fintech partner. So it can all infect each other, and so I think you hit the nail on the head. I mean, and again, it's not, every situation is different, right? It may be that you're willing to take terms, and you're willing to agree to something that you don't want to in order to get it out and prove out a business model. It may be that you are a big established fintech, and you have the luxury of going, and you already have a banking partnership, and you're going to using that to negotiate to get a better one. I think that there's going to continue to be across the map, but I do think that you should be looking at who is going to be a good partner to you and set you up for success. And in part, it depends on how good they are at the things that we're talking about. And I think that you're going to have, I mean, just like we had during the Great Recession, where, you know, in Atlanta, in Georgia, you know, Terry and I used to be full-time depository institution lawyers. And the reason that we're probably not that anymore is because a fourth of the banks failed in the Great Recession, right? And I don't see why, I don't think we're talking about failures here, but I think that, you know, you're going to continue to see banks that are not going to be good at this, that will fail at doing it and be shut out of it. And if that's who you're building your bank, your business on the back of, then that bank poses an existential threat to your business. So take it extremely seriously. And, you know, they are going to be in control of a lot of stuff, but you need to do the due diligence also that they are going to be doing on you, on them.
Yeah, Helen, I know you guys sort of built yours again a while ago and from the ground up, and sort of when there wasn't really a roadmap. Any other comments on that?
Yeah, so a lot of the neobanks that are getting into this space, their first priority is adding volume. They want growth quick, revenue quick, all of that. And obviously you want to make money in the things you're getting into. And so the fintech or banking as a service space is no different. But I will say the banks that have a business model that's more focused on a fewer number of fintech partners, but really looking at those fintech partnerships as long-term partnerships, those tend to be the banks that are a little bit more successful. You know, if you have a really strong relationship and a partnership and it grows as the product grows, we have one in particular that we've been working with, some of our partners we've been working with for 10, 12 years, right? One in particular that's a fairly large one, we started in the prepaid card space and now we're about to do a fifth product with them, right? And it's, we've all kind of grown together. Their customer base has grown, their company's grown, and we've grown along with them. And understanding their business and how they operate and understanding the risks associated with the products. Again, that business model tends to work well. And lastly, I'll say, understanding the elements of the programs you're working with, if there are cross-border elements on programs, some of the banks in the news recently that we've kind of been alluding to, that's where some of them got in trouble. And I'm not saying don't do any programs with cross-border elements, right? But you really have to understand the risk and just make sure that things are being done properly.
You have to build it like a business that you're going to be in for a while.
Yeah, exactly.
Hey, just a couple questions I saw come up. I guess here's a legal question. I'll send it over to you. What about state privacy regulations and FTC obligations for these commercial organizations? Any thoughts on that? Does that apply here, James?
Sure. Yeah. I mean, I think we're focusing here on the bank regulatory environment, but yes, I mean, there are, that's another thing that's a challenge, I think for fintech companies is it's not just, one or two laws. I mean, depending on the nature of your business, you could be dealing with healthcare laws, you could be dealing with privacy laws, depending on the data you have, there's a lots of, fairness to consumer type laws under the FTC, under the CFPB. State law has many kind of UDAP. I mean, you get into a space where you're providing financial products to consumers. It's a whole lot of stuff that's there. And that's so every gyration that we can conceive of law that could be applicable to one of these fintechs is going to be applicable to the bank fintech partnership as well. So yeah, great point. I mean, we're just scratching the surface on the unique bank regulatory in space.
Okay, well, I think that's we're about out of time, and I guess James or Helen, any last final thought?
I'll go first, and maybe James jump in. I mean, we may see, I don't think we've seen the end of some regulatory actions on banks that are, whether it's cryptocurrency. Of course, we're seeing on the front page of the Wall Street Journal and things like that. I mean, I don't think we've seen the end of that. And to Terry's point, you're seeing, investors maybe hold back a little bit, but we're still seeing strong programs and interests that are coming out. There's sometimes the best time to get into a space is when you have these kind of issues. I mean, if you have a good product, I think it'll surpass some of the things that are in the news if you're doing the right things, have the right product, and have the right team around you.
Yeah, I don't know that I think my parting shot would just be to, as you're looking at this and thinking about this as a possibility for your business and a way that you can go forward is through one of these partnerships, is before you start, talking to different bank partners, is to do that sort of readiness check and, think about the due diligence that's going to occur. Think about the contracts they're going to want to see, and so that you're ready for the terms that they're going to impose, or if you're drafting the contract that you're sending to your bank partner, predict what they need in it. It just demonstrates an ability, a level of regulatory sophistication that I think would be appreciated. And then I think the final thing is I would say is this year we've had multiple instances where in the M&A space, we have seen deals get sidetracked because one fintech, as they were doing due diligence on another fintech, didn't like what they found in terms of the regulatory posture of the target. And in both of those cases, in those two cases I think of, the response was, oh, well, we thought we would deal with that later. That it just doesn't work in a regulated environment. Like fixing your stock option plan is one thing, but fixing your money transmission licensing posture is a different thing. You can't unring that bell. And so thinking about that kind of stuff well in advance of interacting with a bank will be in your best interest. And so, that would be my parting words of whatever wisdom they are.
Well, Helen, James, thanks. We appreciate everybody joining us today.
Well, thank you, Terry, Helen, and James for another information-packed session. And thanks to everyone who joined us today. As a reminder, the recording of today's session will be available on the NFO's YouTube channel soon. And that wraps up the NFO's Growth Garage series for 2022, but we'll be back with more in 2023. For more information about the National Fintech Organization and to get involved, visit us at nationalfintech.org. Thanks again for joining us. We wish you all a wonderful holiday season and a prosperous new year.